Welcome to Richard Suttmeyer's 4 in 4. 4 blips on my radar screen presented in 4 minutes or less. My first blip tracks the status of Dow theory. Dow theory turned negative the day before Thanksgiving, confirmed after the Dow Transports closed below its August closing low on November the 7th, and after the Dow Industrials closed below its August closing low on November 21st. In January, I correctly predicted that the January 22nd lows would hold right through March, and the major reason for this call was resiliency from the Dow Transports. The Transports needed to have a daily close below its January closing low of 4,140.29 to confirm the next leg to the bear market. The Dow Industrials, if the Dow Industrials close above its February closing high of 12,743.19, Dow theory shifts to positive. If the Dow Transports closes below 4,140.29, Dow theory shifts back to the negative. Neutral Dow theory suggests that the January lows should hold through the second quarter. My second blip predicts that the deleveraging of risk positions in gold and crude oil will continue. Gold and energy bubbles may have popped, so watch the ranges that have been set. COMEX gold reached an all-time high of 1,033.9 on March 17th, but could not stay above my monthly pivot at 990.4. Look for a wide range between quarterly support at 856.5 and my monthly pivot at 990.4. NYMEX crude oil reached an all-time high of 111.80 on March 17 and is well below my monthly pivot at 109.09 and should continue to trade around my semi-annual pivot at 99.83. My third blip looks at new trading ranges for the greenback. The dollar versus Japanese yen traded down to 96.15 on March 17, a low not seen since 1995, and has since been trading around my monthly pivot at 99.39. The euro traded to a new all-time high of 1.5901 also on March 17 and returned to my monthly pivot at 1.5462. The British pound is well below monthly resistance at 2.0326. Note that cable is kind of between the weak dollar versus Japanese yen and the strong euro. My fourth blip is continuing my thoughts on the saga of JP Morgan and Bear Stearns, from $2 to $10. I don't believe that JP Morgan and Bear Stearns needed to do this deal. I don't think the deal should have been done at all. If Bear had access to the capital on March 17 through the discount window, the market would have been less volatile. The Fed guarantee directly to Bear would have prevented shares of Goldman, Lehman, and Morgan Stanley from reeling as they did that morning. Bear Stearns is a non-bank primary dealer with $13.4 trillion in notional amount of derivative contracts, so the Fed wanted to meld this risk into JP Morgan's industry high $91.7 trillion exposure. Put into perspective, the exposure at Citi and Bank of America are $34 trillion and $32.1 trillion. In addition, if the Federal Reserve opened the discount window months ago, Countrywide, as another primary dealer, could still be independent today as well. Bank of America and Countrywide have similar mortgage issues, and melding the two camouflages pending write-downs from the nation's biggest bank by market cap at $188 billion. Send your comments and questions to support at rightsideadvisors.com. That's today's 4 in 4. Enjoy your day.